Imagine owning a property that's increasing in value while the IRS lets you write off tens of thousands of dollars against your income. That might sound strange at first, but that's exactly how the tax code treats real estate. The real tax power of real estate comes from something called depreciation. And when that depreciation is accelerated using a strategy called cost segregation, something very interesting can happen. You can sometimes create 50,000, 100,000, and even larger deductions from a property that actually is going up in value. For those of you new here, welcome. My name is Alec Friel, I'm one of the founders of Tax Saving Experts. In the last 12 months, we've helped over 270 high-income W-2 employees and business owners save over $12 million in taxes. And cost segregation is one of the most powerful real estate tax strategies we implement for the right clients. So in this video, I'm going to break down what a cost segregation study actually is, how it accelerates depreciation, when it can offset your W-2 income, the biggest mistake people make, and how this strategy actually works in real life. So let's start with the foundation behind all of this, depreciation. Most people think real estate becomes a tax strategy because it produces rent. And yes, rental income matters, but rent is not where the biggest tax power comes from. The real tax engine is depreciation. And here's the simple version. The IRS assumes buildings wear out over time. So even if your property is rising in market value, the tax code still lets you deduct a portion of that building's value each year as if it were going down in value. That's the key idea most people never understand. A property can be appreciating in value in the real world while producing deductions on your tax return, or what we call paper losses, at the exact same time. For residential real estate, the building is generally depreciated over 27 and a half years. So let's say you have a property for $600,000. Not all of that is depreciable because the land does not depreciate. But let's say 500,000 of that 600,000 in value is allocated to the building. So 100,000 land value. That means the IRS may let you write off roughly $80,000 per year in depreciation, even if the property itself is doing just fine. That's why wealthy people like real estate so much. It's one of the very few assets that can create tax deductions while still potentially growing in value. That's the real starting point. But standard depreciation is only the beginning, because once you understand that a building is not treated as a one single asset, cost segregation studies starts to make a lot more sense. Most people hear the phrase cost segregation and assume it's an aggressive loophole. It's not. Cost segregation is simply a method of identifying which parts of the property can be depreciated faster. A building is not just one thing. It's made up of many different components. Some parts of the property last a very long time. Others wear out much faster, and the tax code reflects that. A cost segregation study breaks the property into different buckets with different depreciation lives. Some components may be written out over 5 years. Some other components 7, maybe even 15 years. And the rest over the standard 27 and a half years for a residential property. So instead of slowly writing everything off over decades, a cost segregation study allows you to accelerate a meaningful portion of those deductions into earlier years. That is what changes the game. Think about things like your flooring, appliances, certain lighting or cabinets, landscaping, parking areas, other shorter life components. Those items do not necessarily need to sit inside a 27 and a half year schedule. They may qualify for faster depreciation. And when you speed up those deductions, you create larger write-offs sooner. That is why a normal rental starts becoming a real tax strategy. And that's also why people get excited about cost segregation studies. But here's the mistake most people make. They assume those deductions will automatically reduce your W-2 income. That is just not always true. This is where people either save a fortune or misunderstand the strategy completely. Cost segregation can create huge deductions. That part is real. But whether those deductions actually reduce your W-2 tax bill depends on how those losses are classified. Most rental real estate losses are passive by default, and passive losses generally do not offset W-2 wages. That's the part so many people miss. So they hear about a cost segregation, they hear about six-figure write-offs, they assume that means they can go buy a rental property and wipe out their salary income. Not so fast. If the losses are passive, they usually stay in the passive bucket. That means they can offset passive income, or they could get carried forward into future years, but they do not automatically offset straight against your W-2 income. That does not mean the strategy is bad, it just means you need to understand how it actually works. And frankly, this is where a lot of YouTube videos I've seen on this exact topic get super confusing. They talk about the deduction, but they skip over the classification rules. And the classification rules are everything, because cost cost segregation is powerful, but the real value depends on whether the deduction helps you now or gets carried forward for later years. So the real question becomes this: when can cost segregation actually help reduce my W-2 income? And there's a few main ways. The first path is real estate professional status, also called REPS status. This usually means when one spouse in the household can qualify. To qualify, you generally need at least 750 hours in real estate, property trades, or business during the year, and more time in real estate than any other business. So when that standard is met, rental losses can become non-passive. And that is where cost segregation becomes very powerful for high income earning W-2 households. The second path is the short-term rental strategy. This is the path many W-2 earners care about most. Well, why? Because short-term rentals are treated differently. If the average guest stay is 7 days or less and you material participate in that activity more than any other party, the losses may be treated also as non-passive. That means the accelerated depreciation created by cost segregation may be able to offset active income, including W-2 income. And this is why short-term rentals have become such a popular strategy for high income earners. It creates a possible path for real estate deductions to actually matter against a salary income today. And the third path is passive income offsetting. Even if the losses stay passive, that doesn't make them useless. They can still offset passive income and passive gains. And if they are not used the right way, they generally carry forward. So even passive losses still have value. They just work differently. That's the key message here. The real value of cost segregation depends on how the losses are classified and used. This is the section that determines whether the strategy is just interesting or truly game-changing. Now that you know when the deductions actually can matter, let's talk about the numbers, because this is where people start paying attention very fast. But real quick, if this is making more sense now and you're realizing there's a lot more strategy behind taxes than most people ever heard about, that's exactly why we built our free school community. You can join using the second link below. Inside, you'll get step-by-step guides, training replays, ongoing Q&A support built specifically for high-income W-2 earners who want to stop overpaying taxes and actually start using these strategies the right way. All right, let's keep going. Let's make this real with simple numbers. Imagine you buy a $750,000 property. Now, again, not all of that is depreciable because land is excluded. So let's say after land allocation, $550,000 is your depreciable basis. Without a cost segregation study, that property might produce around $20,000 to $22,000 a year in depreciation. Not bad, it's solid. Now let's say you run a cost segregation study and accelerate a meaningful portion of that basis into shorter life components. Instead of taking $22,000 a year, you could generate $100,000 or more in a first year deduction. That's a massive difference. And the higher your tax bracket, the more valuable the timing shift becomes. A $50,000 deduction means one thing to someone in a lower bracket, but it means something very different to a high income W-2 earner paying the top federal and state rates. And that's where the strategy stops sounding theoretical and starts sounding valuable, because cost segregation does not create fake savings. It pulls future deductions forward into years where they may matter a lot more. And when used in the right structure, those deductions can translate into serious tax savings. But just because cost segregation is powerful doesn't mean it makes sense for every property and every owner. So let's talk about when this strategy is actually worth using. This is where smart planning separates from hype. Cost segregation is powerful, but it should be used where the economics actually justify it. Generally, the larger the property and the larger the depreciable basis, the more likely the study is actually worth doing. If a property is too small, the study cost may not justify the benefit. If your income is low, or if you have no practical way to use the deduction, the value may also be lower. Your hold period on the real estate matters too. If you're going to own the property for a meaningful period of time, cost segregation often has a stronger case. If the property is too small, too temporary, poorly aligned with your overall tax plan, it may not be worth it. The point is not doing cost segregation because you can. The point is to use it when it makes financial sense. The studies costs, projected deductions, and tax brackets all matter. Whether the losses are usable now or carried forward matters. All of that should be thought through before you move forward. And before you run off trying to do this on every property, let's cover mistakes that quietly ruin the strategy. The first mistake is assuming cost segregation automatically offsets your W-2 income. We already covered that, and it's probably the biggest misunderstanding people have. The second mistake is ignoring passive loss rules entirely. The third is weak or missing material participation logs, especially for short-term rental strategies. If you're claiming a non-passive result, your records need to support it. The fourth mistake is failing to place the property in service before the year end. That one hurts because timing does matter. You can't wait until the end of the year closes and expect the deduction to magically appear when it never belonged. The fifth mistake is doing cost segregation studies too late without coordinating it with the rest of your strategy. The sixth is buying bad real estate. Just because you got excited about the tax benefits, tax savings does not rescue bad deals. Good tax strategy supports a good investment, not distract you from whether the investment actually makes sense. And then there's poor coordination with your CPA and weak documentation in general. Tax savings only matter if the structure, the timing, and the records are correct. That's the difference between a deduction that helps and one that disappoints you. So let me show you what this actually looked like in real world for one of our clients. One of our clients, let's call him AJ, was a high income W-2 earner making a little over $400,000 a year. Him and his wife wanted to start using real estate more intentionally, not just as an investment, but as a broader tax strategy. They purchased a short-term rental property for about $650,000. The property had strong fundamentals on its own, but what made the planning especially interesting was the opportunity to combine it with a cost segregation study and short-term rental rules. Once the property was fully placed into service, we coordinated a cost segregation study. That study accelerated a large portion of the depreciation into the first year. The result was well into six figures of additional first-year deductions. Because the property qualified under the short-term rental rules and the client material participated more than anyone else, those losses were able to offset a meaningful portion of active income. That created a major tax benefit in this current year. And the key thing here is this: the property still remained a real investment. It still had revenue and appreciated potential. The tax result was not the investment. It was the bonus and the cherry on top that came from structuring the investment correctly. And that's when cost segregation stops being just an idea and starts becoming a serious tax tool. So if you're considering this yourself, here's how to think about your next step. Start by reviewing your income level and tax bracket. Then identify whether the property fits a short-term rental path or a real estate professional path, and whether it's mainly a passive strategy. Confirm the timing. Will the property actually be placed into service during the tax year? Then estimate the depreciable basis and run the numbers with a CPA who understands this area. Use a reputable engineering firm for the study. Connect with my team and we can assist with this. Track hours and documentation from day one, especially if you're trying to support material participation. And decide whether the deduction is likely used now or more valuable as a carry forward. Cost segregation makes sense when it's part of a plan, not just a last minute tax panic move. That's what turns the strategy from interesting into actionable. And finally, if you're a high income W-2 earner making over $300,000 a year and you want help figuring out whether cost segregation, short-term rentals, or other legal tax strategies actually make sense for you, then tap the top link in the description, book a free tax strategy call with my team. In the last 12 months, we've helped over 270 high income W-2 earners legally save over $12 million in taxes using personalized strategies tailored to their situation. If you want to be our next case study, that call is where it all begins. And if you'd rather keep learning first, watch the next video on the screen. Every way W-2 earners can lower their taxes, all 100% legally. And remember, smart tax planning starts now, today, way before April and tax season.